great story on the Bloomberg talking about how the bond markets are actually protecting Salvini in his standoff with the EU, because investors, in their hunt for yield, in their sort of risk on, when they're feeling risk off, they're still buying bonds and they're still buying BTPs. And so maybe he doesn't see any sense of urgency in changing course at all. What do you expect from Italy? Do you expect this to blow up again once we get into the summer and the really hot months?
I think it will blow up again. This has been going on for 6 months, actually 12 months, and there is a credibility issue around what's going on in Italy. It's impacting on growth, it's impacting on investor sentiment, and one needs to be cautious with everything that is going on in Europe, particularly around Brexit, particularly around Italy. Again, as I've said before with Trump, it's the same in Europe. It's like a game of chess, and it needs to play out, particularly with Italy and what they're planning to do.
Where are you finding the best return right now, Yogi? I mean, are you as well willing to join this kind of hunt for yield, as it looks pretty clear that the EU isn't going to exactly let Italy default?
You know, in terms of where to invest, we would go back to the global equity markets, irrespective of what's going in the bond markets. Bond markets seem very expensive. Look at the US 10-year at 2.11%. These are big numbers, and from our perspective, we are more comfortable with global equity exposure, US equity exposure, even UK exposure, even European exposure at the moment. There are sectors that we are more comfortable with. We're not so comfortable with technology because of valuation and what we're expecting with earnings season in Q2. We do like sectors that have exposure to fiscal spending or infrastructure spend. We're very comfortable with exposure to China at the moment because we think that there will be a resolution to the trade dispute with the US. Europe is caught up in all of this. European sentiment is extremely negative at the moment, primarily because of Brexit, more so than what's going on with Italy, and that will take some time to resolve. The saving grace for Europe and why we're comfortable with equities is twofold. Number one, we have a very weak euro versus the dollar. It's about 18% undervalued on a PPP basis, and we're very comfortable with forward PE valuations in Europe, more so than the US, where you have PEs around 13 to 14.
And let me ask you specifically around the UK then, Yogi, because I know that you're looking for UK entry points, for a UK entry point. What are you looking for exactly? Because this is intriguing.
We're looking for the UK markets to sell off further around election uncertainty and a no-deal Brexit. To us, it's very clear, and we believe the markets are looking at this in the same way. Boris will be the next Prime Minister. There will be no deal. We expect markets to sell off. This will have an impact on trade short to medium term. But remember, the UK is the sixth biggest economy in the world, has a massive service industry that everybody wants exposure to. So whilst we see trade issues short term, longer term, everybody will want to trade with the UK.
So you would push aside comments from Hammond yesterday, for example, saying that Brexit won't happen on the 31st of October. John Bercow, the Speaker, saying that Parliament can't be sidelined. You say that's not the story. The story is that it will happen with no deal.
There is no deal priced into the market. It is a way that everyone in the investment world is looking at what's going on. Boris Johnson is the next Prime Minister, whether you like him or not. You just have to look at the popular vote and what will happen when it gets down to two candidates. And, of course, no deal Brexit on the 31st. Nothing can be done between a new Prime Minister being appointed and the 31st. There's no time.